Good afternoon, everyone. I, CS Dr. Pooja Rahi, on behalf of the Institute of Company Secretaries of India, extend a warm welcome to all of you for yet another enlightening session of EEE 5.0 Master Knowledge Series. The topic that we have today is quite like an iceberg. And this fact is evident from the mail received today in our inboxes. The subject line read, Recent Amendments in Provisions of RPT by SEBI. But it is only on delving deeper that we realize that it is about mastering related party transactions under revised industry standards effective 1st September 2025 and control assessment. And to help us truly master the topic, we have with us CS Narayan Shankar, former Executive Vice President and Company Secretary, Mahindra & Mahindra Limited. An amazingly seasoned governance professional with a penchant for corporate laws, his career spans over more than 3 decades. And during this time frame, he has been recognized for his leadership in corporate governance, building resilient compliance frameworks and steering strategic transactions, including large-scale M&As. We welcome you, sir.
Thank you.
Interestingly, he joined M&M in 2001, and that is the very year that ICSI launched its National Awards for Excellence in Corporate Governance, which the company secured 3 times under his able leadership, amongst other awards. As I share this fact, I am tempted to remind you that the applications for the 7th ICSI Best Secretarial Audit Report Award and the 5th ICSI Best PCS Firm Award are open. And the last date to submit the applications is tomorrow, 25th September. So hurry up. Coming back to the topic of the day, recent amendments in provisions of RPT. To give all of you a brief snapshot of what lies ahead, our guest today would be taking us through the details of the changes made by SEBI at its board meeting of 12 September 2025. Given the significance of the topic for us professionals, he will also be bringing to board a separate vertical for helping company secretaries assess control from the various clauses appearing in the shareholders' agreement. This would include key governance oversight matters of relevance for CS, takeaways for control trigger in transactions, step-by-step process for CS along with templates and framework to assess control, and lastly, approval process with backups for audit committee shareholders, including disclosures and documentation. Having mentored company secretaries of listed companies and played key roles in SEBI committees, it's time we sought his guidance in strengthening our footing in the matter of RPTs. As we start, I would like to request all of you to share your queries, and we'll be taking them at the end of the session. Over to you, sir.
Are you able to see my screen? And one
Yes,
minute,
sir.
let me go into the PPT mode. And how do I reduce? 1 minute. Okay. Friends, a very, 1 minute. How do I get out of this? Okay, it's gone. Oh, again. Okay. Let me go ahead. So, ICSI, thanks for giving me this opportunity for sharing my views. Friends, as you're aware, the topic, the anchor has already, Pooja has already made mention. I don't want to repeat the same. However, what I will try to do in this next 2 hours to 2 or whatever time we get is to try and complete as much as possible with regard to the new revised ISF standard on related parties, including the changes which have been made by SEBI at its board meeting on 12th and September 2025. And towards the end, the last half an hour or something, I will try to devote on how to help company secretaries assess control from the various clauses of the shareholders agreement. Let's start. with regard to the SEBI board meeting, as you're aware, first is the scale-based threshold for material RPTs. Currently, the material RPT threshold is 1,000 crores from 10% of the annual consolidated turnover, whichever is lower. And in case of a royalty, if it is 5% of annual consolidated turnover. And in case of SME listed entity, it, it is 50 crore, 10% of the annual consolidated turnover. This is the current threshold for the material RPT. Based on recommendations from industry, what SEBI has done, SEBI has approved it on 12th September, that what is the flat 1010% flat threshold, they have now changed it to a scale-based threshold for material RPTs, correct? And this you'll find it in 3.3.1 of the SEBI press release, which they have released on 12th September, is an outcome of what they have approved board meeting. So if you see today, all material are related party which has to go to the shareholders, correct? It will be in three buckets. One, up to 20,000 crores, it is flat 10% of the annual consolidated turnover. Between 20 to 42,000, which is from the first row, plus 5% of annual consolidated turnover of the listed entity, about 20,000 crore. And the third bucket is more than 40,000 crore, which is 3,000 crore plus 2.5% of ACT above 50,000 crore. And this is subject to a cap of 5,000 crores. So if you see what was a flat 1,000 crore or 10% is now split into three verticals. And to get it better, let us see some illustrations which will help us uh, decipher this better. Okay, this is the illustration. If you see annual consolidated turnover is 30,000 crore, today you will have a you will have a limit is 4,500 crore. For example, if it is 50,000 crore, it is going to be 3,250 crores. And if it is 1,50,000 crore, it is now going to be 5,750 crores. So if you see, if you are in a 20,000 crore company, it is going to say if you are in a 30,000 crore company, what was originally 1,000 is now going to become 2,500. If your turnover is in the range of 50,000, it was 1,000 is now going to go to 3,250. And if you are 1,20,000, your one becomes 5,000 straight. And if your turnover is above 1,20,000 francs, then the threshold for material RPT, as we said, the cap is 5,000 crore. Hence, above 1,20,000, even though mathematically you will go beyond 5,000, yet all RPTs above 5,000 crore will have to go to the shareholders. I thought it is hugely beneficial for industry at large, correct? And from the coming year, we will find the number of cases which goes to the shareholders are drastically going to reduce, correct? And if I had to summarize the scale-based threshold for material RPT, here it is. If you see currently 1,000 crore or 10% of annual consolidated turnover is going to now shift to three buckets of 20,000, 20 to 40, above 40,000 crore, correct? Royalty and SME remaining the same. So what was a flat 1,000 crore or 10% is now a scale-based turnover. We will go to the next topic, which is approved at on 12th. That is revised thresholds for approval by audit committee for RPT undertaken by subsidiaries. Okay. And currently, if you see what is the broad threshold of subsidiary entering into any RPT, which is 10% of its standalone turnover, prior approval of listed entity audit committee is required. So if you really see what was the issue really coming up with, which I'll go to the next, is there were cases where the 10% was below the scale-based threshold for the material RPT of the listed entity. Hence, today SEBI has split this subsidiary threshold into two cases. One, subsidiaries having audited financial statements. Okay, if it is for entities of course, de minimis of 1 crore will still apply. 10% of the subsidiary standalone turnover or listed entities scale-based threshold. Again, listed entities threshold under 23(1) is no longer 1,000 crore or 10%. It is going to be the three verticals. So today for subsidiary, it is going to be 10 with having audited financial statement. It is going to be 10% of the subsidiary standalone turnover or the listed entities scale-based threshold for material RPT. We will now go to the second category, that is subsidiaries not having audited financial statements for the last year. In this case, it will be 10% of the subsidiaries paid up capital and securities premium, not the listed entities scale-based threshold for material RPT. Here, if you see there is slight change which they have made, what was there in the consultation paper vis-a-vis what has now come out in the board meeting. In the consultation paper, they had made a mention that if there is positive net worth, then it will be 10% of the subsidiaries standalone net worth, and that was certified by SCA. And if you do not have a positive, if your net worth is negative, then they said that is 10% of paid up capital and securities premium. They have removed this bifurcation of negative and positive net worth, and today there will be only one single threshold, that is 10% of the subsidiaries paid up capital and securities premium, or the listed entities material equity threshold, whichever is lower. Okay, so the two three changes are also one, because the net worth is gone, it is plain capital and securities premium. The certificate by CA also has been dispensed with. Actually, it is not visible in the press release. And data based on latest 3 months, which was a requirement, is also you're not able to see it in the press release unless it comes back in the actual amendment that they do in the listing agreement, correct? So, undoubtedly, the data will need to be as close as possible to the audit committee approval today. And as I mentioned, distinction of subsidiary having positive net worth has been removed. Single yardstick for subsidiaries not having audited financial statement, and that is use paid up capital and securities premium instead of net worth. Let's go to the next. Here is again a relaxation and applicability of industry standard forum for simple disclosure for smaller RPTs, correct? Today, what is the threshold for applicability of IS? As you are aware, you don't need to follow the RPT industry standard if the related party transactions are up to 1 crore.
Sir,
Okay?
I would like to
Yeah.
interject a bit. Your voice is not clear.
One,
Yeah.
my yeah.
Now it's okay.
Is it better?
Yes, definitely.
Okay, so let me use this then instead of the
Thanks.
earphone. Thank
Yes,
you for telling me in time.
thank
So, what I wanted to make a mention is that if there is, in respect of current threshold, it is 1 crore, and this applicability of ISF is now also going to increase, correct, substantially. What they have done is now the revised threshold of 1 crore is now going to be 1% of the annual consolidated turnover or 10 crore, whichever is lower. And this is again going to be subjected to the de minimis of rupees 1 crore, which will continue to apply. So the 1 crore which was there, current limit for industry standard forum, is going to go to virtually 10 crores for large companies. Here again, let us see some illustrations. Here is in the case, here is a company which has the annual consolidated turnover of 1,200 crore company. 1% of this is 12 crores. However, what we said is the threshold is 1% or 10 crore, whichever is lower. So 10 crore will be the threshold, as 12 crore is about 10 crores. And in this case, it will be 10 crores. Let us see three categories. This particular company is going to do an RPT of 75 lakh. If it is below 1 crore, correct, up to 1, not exceeding 1 crore, rather I'll put, neither the industry standard forum on RPT, nor what is, there is a proposed circular for small transactions, correct, both of them don't apply. However, if it is a 5 crore, if it is row B, if you see, if it is a 5 crore transaction, then information specified in a proposed circular will apply. What I want to say is For those cases, if it does not exceed 1% or 10 crore, whichever is lower, subject to that 1 crore, then they have proposed a circular in which certain bare minimum items will have to be given. Okay. So if it is 5 crore, it is below the 10 crore. So all that items which are going to be coming in a proposed draft circular, that will have to be followed. Third, if they do RPT of 15 crore, you will have to then follow the RPT industry standards for it. Okay, is that clear? So now if I want to summarize all the three things which we today saw with regard to applicability of the related party transaction, it is going to go into three verticals. And let us see what are those three. Vertical 1, okay. Vertical 1, we said material related party transaction is going to be now scale based, which is 20,000, 40,000, and above 40,000 it will be. Second, the second vertical is other than material, which is 1% of the annual consolidated turnover or 10 crore, whichever is lower, subject to de minimis of 1 crore. And the last, which we said, is residual RPT. That means if the transaction does not exceed 1% of ACT, annual consolidated turnover, or rupees 10 crore, whichever is lower, then the proposed draft circular will apply. And let's see the proposed draft circular for such residual RPTs. If you see, the items mentioned over here, like type, name, tenure, value, these are all nothing but it is virtually the same which is there currently in the master circular, which is there in the annexure, the master circular of 2024, correct? So here is the case where for small value transaction, okay, this is to be going to the audit committee, and same for shareholders, correct? So these are bare minimum small level disclosure required for small level RPT transaction where the RPT industry standard forum RPT will not apply. Now let's go to the next fourth item, which is more a clarification which is already given for validity of the omnibus approval for RPT granted by shareholders. As you are aware, provision pertaining to validity period is contained in the master circular on LODR, which is based on a circular which they had issued earlier. Okay. Today, currently planned for validity of omnibus approval, 23.3 mentions that audit committee can grant omnibus approval for RBT and it is valid for 1 year. 23.4 needs prior approval of shareholders. The master circular, which is there currently in the November 24 circular, which was there based on the earlier circular, clarifies that omnibus RPTs approved in AGM is valid till next AGM, but not more than 15 months. And if it is approved in any other general meeting, it is going to be valid for max 1 year. Companies Act, as you're aware, gap between two AGMs cannot exceed 15 months. The master circular provision, they are just going to reflect it in 23.4 because the requirement was it needed alignment. Okay. So what is the amendment which is proposed? Amendment regulation 23.4 will include the fact that AGM approval is valid till next AGM. And for other general meetings, the validity of the omnibus approval is 1 year. Here, friends, I want to make a mention. Many company secretaries are taking a view that there cannot be RPT approvals other than omnibus. I think it's a wrong notion. If you have specific agreements, specific arrangements, correct, you will go for that specific period for which there is an agreement where there is detailed terms and not merely an omnibus. Let me give an example. Suppose you want to set up a power plant, correct? Okay, and that is done in a subsidiary. That power plant purchase agreement may be for 5 years, 8 years, 9 years, whatever. The approval which you take from shareholders then cannot be shifted to a year to year omnibus because that is not an omnibus approval. It is a specific. So a lot of people get into this confusion that they can only go on a year to year basis, and as if specific RPTs are completely out of the window. Answer is no. In fact, SEBI had made this circular to help industry
because the omnibus approval was valid for financial year. And the question raised by industry to SEBI was between 31st March and September, where you will have the AGM, again the companies will have to go for a postal ballot. To address this, they had given a clarification that if you take omnibus at one, you can continue till that will continue till the next AGM. Again repeating, it does not take away the right of the company to go in for specific RPT, the way I say, whether it is power purchase plant, setting an engine plant in your subsidiary, where you have a specific agreement. Okay. The next point is applicability of RPT provisions. Applicability of RPT provisions, friends, as you're aware, 21ZCE. Retail, there are exemptions given to directors, employees, correct? Because if you're giving it in the same term which are uniformly applicable to all employees and directors, then they say directors, employees, all can be exempt. Today, two or three issues have been flagged before SEBI. One, employees are not related parties under Companies Act unless they are KMP, correct? So exemption is not necessary. And second, exemption should also cover relatives of directors and KMP. So the change which is being brought about is directors, relatives, directors, KMP, and their relatives is going to be added. Okay, that's a simple change. The next one is more a clarification. As you're aware, 23(5) exempts RPT between holding company as well as two wholly owned subsidiaries. They have just they are clarifying that the word holding company, which is inserted in 23(5)(b), refers to a listed holding company and not an unlisted holding. The companies were always following this, nothing new, but more a clarification for those of us, probably if you had a doubt in this regard. We will now go to the industry standard forum minimum information to be placed before the audit committee. As you're aware, this industry standard forum note provides a standard format for minimum information to be provided to the audit committee and shareholders for review and approval of RPT. Okay, if you see RPT standard audit committee in terms of uniformity, audit committee gets better oversight, management benefits from clearer compliance guidelines, correct? Shareholders will enjoy stronger governance standards and regulators can definitely enforce compliance more effectively. If you see the overview of this industry standard forum, you will find applicability of RPT standards, words and expression definitions, which is called guidelines for placing information before the audit committee. And number four is format for information to be provided before audit committee and minimum information to be provided to the shareholders for approval of material RPTs. Let's go quickly to the definition. As you're aware, the words and expression, if it is used in SEBI LODR, please go for it. Else, if it is used in SEBI Act, Companies Act, SCRA, so it will accordingly apply. Correct? Guidelines for placing information to the audit committee. Guidelines for placing, as aware that you require all information as specified in para 4. A certificate is required from CEO, MD, whole-time director, confirming that the terms of RPTs proposed to be entered into are in the interest of the listed entity. Copy of the valuation or other report of external party. Okay, and where a field is not applicable, you will have to indicate not applicable with reasons unless it is self-evident. If audited financials of RPT is unavailable, then you will have to provide financial extract from books relevant to the RPT industry standard. And in case of multiple types of transaction, details to be provided separately for each type of proposed transaction. If you see minimum information to be provided for shareholders, information as placed before the audit committee to the extent applicable, justification why it is in the interest of the listed entity, basis of determination of price, other material terms and condition, disclose the fact that the audit committee has reviewed certificate provided by CEO MD. Okay, disclosure that material RPT or any has been approved by audit committee and recommended by the board for the shareholders. Provide web link for and QR code for valuation reports and other reports. Audit committee, there are also provisions for redaction, which we'll deal later. And now let's go to the formats. As you're aware, first is applicability metrics. So applicability matrix is into three verticals. One, one is A1 to A5, which are basic details, relationship details, amount, basic details, etc., which applies irrespective of the type of transaction. The second is B1 to B7. These are information which you have to provide where you go for specific transaction pertaining to sale or purchase of goods, loans, investments, guarantee, comfort letters, borrowing, sale, lease, royalty. And if it is material, material means not the 1,000 crore. Today, material means the scale based, which we saw into three verticals, 20, more than 20, 40 and above, correct? Those three. Uh, and if it is crossing that, then those mentioned in C1 to C6, again, for loans, advances, investment, guarantees, borrowing, sale of assets, and royalty. Okay. And there are certain questions which are there with regard to applicability. Let's take one of them. First is, do the RPT standards apply to high value debt listed entities, especially in light of Chapter 5A and Regulation 62? I've seen many companies taking a call that every company which has high value debt listed entities will have to follow 15 to 27, and because this RPT industry standards comes under 23, they will have to follow. That is not the case. RPT standards have been formulated under 23, that's clear. However, listed entities that have non-convertible debts securities with outstanding value of 1,000 crore or more, which we call high value debt listed entities, are now with effect from 1st April 2025 are required to comply only with Chapter 5A, which is I think 62B to 62Q. However, if such a high value debt listed entity also has specified securities like equity, then it will have to comply with 15 to 27. However, if you do not, if your merely debt is high value debt is listed and that is not coupled with any other equity, then you are not required to follow the RPT industry standards at all. Okay, let's go to the next. Non-applicability of the industry standards. Okay, transaction exempted under 23(5) and quarterly review. Here, both the cases it will not apply. As you're aware, okay, for 23(5), there are many transactions, including transaction between holding company and wholly owned subsidiary, two wholly owned subsidiaries, quarterly review, etc. All that will be exempt. You also have to go through the exemptions given in 21ZC. For example, issue of specified securities on a corporate action which are uniformly applicable to all shareholders like dividend, subdivision, consolidation, issuance of securities on rights, bonus, buyback. All these are exempt. To understood, it is going to be exempt from the purview of related party transaction itself. Okay. Now, uh, of course, we talked about holding company being clarified. It is going to be a listed holding company. That is more a clarification. As I said, companies were always following that. Let us see the next question. Does RPT industry standards apply in cases where omnibus approval has been sought for unforeseen related party? Undoubtedly no, because 23(3)(c) clearly state that approval can be sought of the audit committee for unforeseen RPTs exceeding 1 crore, correct? RPT industry standard do not apply to transaction for such unforeseen transaction, correct? If transaction is not covered under B and C, will it still have to go with and comply with the RPT industry standard? Answer is yes, because as I said, it is into three vertical. Even if B and C doesn't apply, you will have to follow para A, which is there in para 4 of the executive summary of the RPT industry standards. Okay, so because para A applies to all RPTs unless exempt under the relevant industry standard forum. Okay. This is another question which we received of saying that we are a debt listed company. Our holding company is a listed entity. Whether disclosure as per ISF is applicable, because it is going to go to the audit committee of the holding company. As you're aware, under Regulation 23, a RPT to which subsidiary is involved okay, is not a part, but the list is subsidiary is a party, but the parent is not a party. They will require prior approval if the value of such transaction entered into exceeds 10% of the annual standalone turnover of the subsidiary. If it crosses this 10% limit, then even though you're a debt listed entity, but your holding company is listed, you will have to give all the information, including certificates from your end as a backup for your parent company, correct? So AC of the listed company cannot give information informed approval without complete disclosures from the subsidiary. So you will have to give it. Okay. Are RPT transaction, RPT industry standards applicable to transaction between foreign subsidiary? Answer again is yes, provided the value crosses the 10% limit, which we just saw. Is the 1 crore applying threshold applied to individual or it is an aggregate? It is on an aggregate value of all transaction with a related party will be taken. Okay. Will, this is a question which comes in many sessions, and hence I wanted to just spend some time on this particular point. Okay. Will reimbursement of expenses by a related party, is it a RPT? Correct. Many companies are probably compliance officers taking that many a times we are not going to make that reimbursement or without any cost or without a profit element. Answer it irrespective whether reimbursement are even made at cost, that is no profit element, they will still qualify as RPT because it is transfer of resources, correct? And they will require disclosures. And if you see them, if you are in a large corporate, if you will have multiple reimbursements going on. For example, you will have employee cost, parent company paying salaries, subsidiaries reimbursing. In when you are doing this, you have to ensure that as part of this, you obtain payroll records. Okay, document what is the basis of allocation. Is it headcount, timesheet, trace reimbursements, document approval, and intercompany agreements? Correct. Keep it all ready for your audit committee approval. Next is you'll find administrative and office expenses like rent, utilities, security, IT, infrastructure, correct? Here as CS, you will have to confirm that invoices and bases have been verified, correct? Whoever by accounts or whoever. For example, the rent, utilities are allocated basis of area occupied by the subsidiary, correct? Usage logs, for example, if it is in terms of IT, lease agreements, correct? Approvals under 188 if required, and other disclosure if it is required. The next will come professional consultancy, legal, audit, and various other fields. Ensure that you're comparing it with engagement letters, review allocation rationale, cross check with services rendered to all entities, correct? Then you will have travel and training expenses. Many a times you will find joint programs or foreign travel sponsored by parent or holding company, correct? Correct. In such case, ensure that there is proper approval from the HR and there is a review of unusual trends if you see it in this regard. Next is IT, technology, ERP sharing, server holding. All this are what I can say paid by the holding company many a times and then charged to the subsidiary. You will have marketing and branding costs sometimes, central ad expense campaigns, correct? So here there are, when you're doing marketing and branding, many a times invariably it will be expensed normally, correct? However, only if it creates, if you are doing a branding exercise, only if it creates a separate identifiable asset. For example, if it is an acquisition of a trademark, brand, license that is controlled and expected to generate economic benefits, can it be capitalized? If you take some example, broadcast rights, is to say that if the expenditure, you have to ask few questions. Does the expenditure create a separate or create a separate asset? Can it be sold, licensed, transferred? If the answer is yes, probably again you could capitalize this. Does the company have legal rights, control over the output? Will the asset generate, you can say, future benefits over the useful life? Does the benefit extend beyond current accounting period? Can cost be reliably measured at least and allocated to the asset? Is there a contractual or legal right created by this? If the answer to all these questions are yes, then it is passing the critical test and you can probably capitalize. If it is no, then you will have to expenses. So you may probably use these questions as a checklist whenever you're reviewing marketing or branding cost, correct? More important, sometimes even statutory fees are paid. Your filing fees are paid at the holding company and then, debited to the subsidiary concerned. CSR, sometimes that is common projects, correct? CSR expenditure, as you're aware, cannot be shared unless approved as a group activity because you'll have to comply with 135 and Rule 4 because companies will collaborate for CSR project provided each of your subsidiary or your company can report separately on certain projects and allocation of expenditure is proportionate and not simply pooled, correct? So we saw multiple cases of reimbursement, whether it is employee sharing, administrative costs, share, professional and consultation fee, travel, IT, marketing, brand, statutory levies, CSR, correct? So hence be extremely careful that these are all RPT transactions and ensure that they are properly approved by the audit committee and also disclosed. Here is a question generally asked. If you have a listed company, if you hold 60%, that is a subsidiary, and that subsidiary in turn holds 51% in another entity, or can you take economic interest of 31%, that is 51 of 60%, and say there is no control? Answer is certainly no. Subsidiary includes a company in which the holding company controls composition or has more than 50%, correct? So even indirect control via another subsidiary comes under control. So hence, irrespective of what is the percentage of your subsidiary, if your subsidiary holds majority in any other company or controls the board, they will again come under the control right up and it will come as part of the control mechanism. Is it the next question? Is it mandatory to provide QR code and web link for valuation reports or any other reports, and are both required to be disclosed? Answer is yes. Both web link and QR code should be disclosed in the explanatory statement for accessing valuation report or any other report considered by the audit committee while approving RPT. What are the reports of the external parties? Other reports, correct? Apart from valuation, which are required to be placed before the audit committee. Here, please ensure two things. One, if you see the language, it is external party. That means only if you're going for an external validation or a report like benchmarking, arm's length, transfer pricing, justification, expert opinion, fairness opinion, do you have to really place it before the audit committee and the shareholders, correct? If it is material. So, but beyond this, you will also, as CS, go through transactions where you are specifically going to sometimes seek some reports from outside. And with my experience, I can just give you a flavor of few of these cases where we go for some backups, correct? And then on case to case basis, every CS will have to say whether each of these reports will qualify as this other reports of external party. And if it is yes, then it will have to go not only to the audit, but also to the shareholder. Let me take few example. Transaction sometime which has no business rationale. They don't seem to have legitimate or documented business purpose. Loans to related party without security or clear repayment. There may be a strategic reason involved. I'm not saying no. But if there is no business rationale and you're creating a documentation, if it is external, this will come under the external reports of external party, which requires disclosures. Transaction, for example, unusual terms of pricing, where the terms pricing credit period are significantly different from market or internal policies. Selling goods to a related party at a deep discount or below cost, then you will have to say if you're taking report whether it comes under this vertical. For example, you will have round tripping or circular transactions where funds moved between related party without genuine substance. A related party invests funds which are immediately returned as payment. This is exactly what had happened actually, if you see in Gensol, while if I'm not mistaken, it was Go Auto, one of the dealers, where money was actually shifted to it for buying EVs, electric vehicles. However, there was complete round tripping done, and in fact, even promoters' preferential allotment which they did came through this relate round tripping, and money in turn went to the promoter, and the same promoter gave the same money to the company. You'll have to be careful, correct, on this. So many a times you'll have fictitious agreements, you'll have to be careful. Agreement executed after the transaction date or retrospective effect without documentation. Service agreements, for example, are signed after services were rendered. So you will have to have enough backup for that. Transaction lacking proper documentation. For example, if there is a lack of contract, invoices, and if you're getting any report to justify this, payment made to related party, whether this comes under this, it will have to come. One time or non-recurring transaction. See, there may be sometimes unusual transactions, friends, that are not part of your regular operation. Sale of a asset to a related party is not, you don't do it regularly, correct? So, two things. One, you will have to first see whether it comes and fits in your OCB. And second, other documentation which are required to ensure that these are at proper arm's length and in the interest of the company. And last but not the least, I will say complex or structured transaction. Transaction, I will say, with layers or special purpose vehicles that obscure the nature of the transaction. For example, use of intermediary entities for lease arrangement is quite common, correct? In these, you'll have to be extremely careful whether it comes within this vertical. Transaction with entities having little or no business stands be said. So hence, what is the CS required to ask the following? Whether the transaction is consistent with the entity's normal business operation. Is there any risk of material misstatement due to wrong disclosure under ISN? Obtain sufficient evidence and confirmatory documentation. Ask accounts team to check approval, pricing, rational, disclosure under LIS under various clauses, and the arm's length basis. More important, that it is in the best interest of the company. Correct? I am not saying that every of the example which I gave will fit in. All I'm just trying to caution you, these are few examples coming to my mind which you will have to exercise caution and on a case to case basis define and decide whether it will come under the vertical of other reports of external party. The same example which I gave, if you are doing an internal assessment, my view I am telling, it doesn't come under because it is not reports of an external party. It need not go to the shareholders. However, again, as I said, each of the cases which I said, you will have to go and analyze on a case to case basis. Do all comments of the audit committee on the information provided by management need to be captured in the minutes, or are the comments regarding unapproved RPTs are required? If you see the RPT standards required that if audit committee does not approve a related party transaction, the comments and the rationale for not approving the RPT will have to be recorded in the minutes. Further, the RPT standards also has an enabling provision that audit committee at its discretion can comment on the information provided by the management. Such comment should be captured in the earlier. There was a requirement for audit committee to have a comment on each of it, correct? That has been removed because it was quite onerous, and today it is merely an enabling provision, correct? What should the listed entity do in case related party is not willing to provide financial? This question, friends, come from many parties, many people, because if it is a entity which you are controlling, correct, which is your subsidiary, it is okay. But if it is outside your group, it is a related party. The listed companies may find difficulty in disclosing everything which is required for audit committee because there may be non-availability of some financial details or some other. I feel if you take a practical stand, the management should disclose information available, and for information that is inaccessible, if management can certify to the audit committee that despite best efforts, information could not be obtained, and management confirming that the disclosure which are currently available are still enough for the audit committee to take an informed decision and decision making, correct? Then I think should work out. But again, it will be case to case basis on what is the type of information which you are not able to get, correct? It is not all information, it will be only some, and how material that is. Next, what can be redacted? As you're aware, what is allowed to be redacted by the audit committee are those which comes under commercial secrets and any other information that may affect the competitive position of the listed entity. Such redaction is allowed only if, in the opinion of the audit committee and the board, the redacted disclosures still provide sufficient information for shareholders to make an informed decision. The redaction, as I said, will have to specifically be approved by the audit committee. And as far as a backup for the audit committee, the management should confirm to the audit committee as part of the CEO and CFO certificate that the redacted disclosures still provide all necessary information for informed decision making. Okay, so we now see, we saw the uh, what I'm telling, we saw the three verticals. We saw A1 to A5, which will apply to all, B1 to B7, which will apply to specific, C1 to C7, which will apply to specific where it is material. Okay. So if you see the applicability matrix, A1 to A5 for all, and depending on the type and materiality, B to B7. For example, let's go quickly. If you see A1, name, country, nature of business of the related basic details, please ensure that you put everything of this in place, correct? The next is relationship, shareholding, indirect shareholding, and a lot of things are there. So here in terms of relationship, ensure that you give both financial or otherwise between the listed entity and a subsidiary and the related party. For example, is the relationship of a strategic partner, joint venturer, is it a lender, customer, or a supplier? In terms of shareholding of listed entity, state direct or indirect shareholding percentage held by the listed entity, subsidiary in the related party. And if the related party in the third point, partnership firm or a body corporate without a share, then state that capital contribution which is made by the listed entity in the related party. And with regard to shareholding, state direct and indirect shareholding percentage held by the related party in the listed entity. One of the things which I wanted to point out is disclosures apply regardless of whether subsidiary is a party to the related party transaction. Because for RPTs undertaken by listed entity, the disclosure of subsidiaries shareholding is still required. Because this is why, because subsidiaries are controlled entities and their indirect holding in the RPT affects the overall group, correct? So hence that is required. So if I have to put some broad question, what is the shareholding disclosure required if a listed entity does purchase sale good? The disclosure will be required listed entity in related party, subsidiaries of the listed entity in related party, any other controlled entity of the listed entity or the subsidiary company. What is the shareholding disclosure required if a subco does the purchase or sale of gold and not material, that is, it is not crossing the 10% limit for the hold co, correct? 10% of its annual consolidated standalone turnover, which is the threshold for subsidiary. If it is not crossing 10%, then disclosure required will be only of subco. Subco will have to do it of his own subcos, any other control relative of subco, and listed entity in the related party. If you are having a transaction which crosses of the subsidiary 10%, then subsidiary company and its own subsidiary companies, the parent listed entities, other listed, sorry, the other subsidiaries of listed entities and any other controlled entity of the listed entity in the RP, correct? If there is any default, the next is if there is any default, the type of default will have to be being mentioned, whether it is financial, delay in timelines, contractual defaults, failure to complete project, failure to deliver goods, failure to fulfill obligation, delay in payment, any other contractual, material breach, invocation, correct? What are we trying to do is what is meant by default made by related party concerning any obligation undertaking by, if you see on the list, under a transaction or arrangement entered with the listed entity or subsidiary during the last financial year. Okay, so first try to say what comes under default: any material breach of obligation undertaken by related party, any financial default, failing to honor guarantees or indemnities. Uh, so hence, first construe what is default, seek details of default, if any, made by the RPTs. Default may pertaining to borrowings, for example, from the listed entity, correct? Obtain information from the related party. But besides obtaining information from related party, try your best to verify the same from publicly available source. For example, audited financial statements of the related party. Any default, for example, on obligation with the transaction undertaken by the related party with the listed entity or subsidiary. Ask question to your finance and treasury: has anything of this related party moved to an NPA, for example? For example, have they defaulted any principal or interest with a bank? Has any RP related party taken a haircut or any extension of period, or they have asked anything extension of period of an existing financial obligation? Any payment remaining outstanding, for example, cash credit, OD facilities, more than 90 days. If there is any invocation of guarantee, correct, is it still subsisting? Um, is it a willful defaulter? Is it coming under 29A? And we ask company secretaries to say, can you peruse RBI and other relevant regulatory website to verify whether any of the related parties or their group entities have been classified as willful defaulters. You can go through the RBI. While RBI does not have a, and they themselves do not host a searchable list of willful, but RBI requires banks to report willful defaulters. Specifically, if it is more than 25 lakhs, I think that was the threshold. And periodical issues, and banks will have to issue such master direction. RBI issues to the bank. So go through the master circular on willful defaulter. Actual list is published by banks. You will have credit information companies. These are RBI generated regulated entities, correct? Where bank report where there is a willful default clarification. For example, you've got TransUnion Sibyl, CIRF high mark, I think. Experian you'll got. So many of these platforms sometimes may also, you'll have to be careful, may require a subscription or authorized access. Lenders, banks, and NBFC typically use these for due diligence. Public sector bank disclosures as per RBI mandate, correct? Ask finance to probably peruse the RBI and other websites to check the name of the RP in the list to confirm whether the same has been declared as a willful defaulter. Scan public announcement under section 15 made by the interim resolution professional for submission of claims in the newspaper. Scan IBBI database for admitted what we can call CIRRP cases, and you'll find it in IBBI, I think .gov.in also. Okay. The next we will shift into basic details of the proposed transaction, and while I will skip the first five, the last is important, specifically in terms of justification and commercial rationale and business as to why it is in the best interest of the listed entity. Many a times at a group level or in companies, transactions where the objectives will invariably be major non-financial justifications. Okay. And the non-financial justification can be many: operational continuity, alignment to group, access to propriety, many. Oh, see, let me give you a few examples. For example, brand and trademark licensing we saw. Parent licensing the common brand and gives it to the subsidiary. What is the strategic intent? It will ensure uniform brand identity across geographies, correct? RPT approvals, disclosures, even if no charge is made. I had repeated it in the time of reimbursement. I'm repeating, even if there is a no charge paid, even then it is a related party transaction. For example, in automotive companies, you'll have a shared R&D platform or technology pooling. Correct. Group companies contribute to a common R&D center. What is the strategic intent, friend? Leverage synergies for innovation, reduce duplication. So you will have to allocate cost and it has to be in a transparent manner. It will require disclosures. Centralized marketing campaign. Parent anchors global advertising spend for a group brand. Subsidiaries benefit without direct charge. What is the strategic intent that you're not? Because it is strengthening the global market positioning of the group as a whole, correct? Hence, you will have to see it in a holistic way as to how, even if there is no charge, there is still a transfer of resources, and hence it is an RPT. Cross licensing of patents. Group entities exchange rights to use proprietary technology. What is the intent? Strategic market access, competitive positioning, correct? Management secondment. In big companies, friends, you will see that entire pool of talent is a group talent, correct? It is viewed as a group talent. How senior executive who are talented are rotated across group companies without full cost recovery. So many a time, what is the strategic intent? Leadership pipeline and uniform culture if you want to create across the group. Here again, many a time, the executive at the parent company may do a services, and if you want to support the subsidiary, it may not be at the full cost recovery. But you will have to probably give the strategic intent behind this, correct? Similarly, we have strategic supply procurement arrangement. One group entity acts as a central procurement. Why are you doing this? There is group wide bargaining power and consistency of quality, correct? So whether the transaction is may have non-financial justification is more important for company secretaries to peruse, because as I said, you will have to document in your audit committee that the transaction is essential for, say, uninterrupted operations of your group, correct? For example, if there is a sale of key raw material, I will not be comfortable depending on outside. I will always want a group company to be doing, correct? Similarly, if the related party provides unique skills, regulatory expertise, company secretary or legal at the parent company, it is always better because it is internal, correct? And many a times, many of the skills are not available externally, correct? And we said you can document that many a times you're doing it for preserving your intellectual property or economies of scale, correct? Shared services, I say HR, finance, secretarial, legal, correct? Major customers are requiring certain arrangement within the group, correct? Many a times while we talk of all this, you will all ally government contract awards to a consortium where a group entity is the lead. But most important, many a times, speed in agility is most important in business today. Transaction with a related party may allow quicker decision making, quicker turnaround time, quicker execution, correct? Because you're doing it with a party with your, because you have a trust compared to a third party negotiation, correct? And these are some of the things which you will have to document, which may be non-financial justification. On the face of it, you may not be able to justify, but in a group concept, you will be able to justify why are these certain structures. Maybe it is tax efficient, required by regulatory norms, distribution channels, which we say you want agility, you want retention of control, and you want ensure that key customer relations remain within the group ecosystem, correct? And last but not the least is confidentiality. You may want certain information only within the group. So hence, please ensure that you properly document that while the transaction involves a related party, it is being proposed not only on commercial terms, but also for strategic reasons. And we saw the whole lot of strategic reasons I gave, whether it is operational continuity, alignment of group level synergies, access to proprietary capabilities, which are not readily available in the market. If you document, you will really be able to completely fulfill what is required under A5. We will now go quickly to buy and sale of shares, sale of goods and services. One of the first requirement, if you are saying, is bidding or other process which is required. Describe the process for bidding, method of selection, internal policy, etc. Okay, and basis of determination. One of so if you see the RPT industry standard mandate disclosure of bidding if any. Many a times company secretaries in where we have had session in other companies, the flag they have been receiving because they have just copy pasted this entire industry standard forum and send it to companies asking them to fill those templates, correct? And there is a lot of pushback from the business team to say this is business as usual for us. We don't do a bidding is not conducted. There are it is normal business, correct? Hence, CS will have to probably handle business team to say that even if bidding is not conducted, is there any other process applied for choosing and for doing business, correct? Uh, if there is no bidding, correct, what are the other common methods which are in? So one of the common methods which we say is what we call is um, comparable uncontrolled price, which we call CUP method. What is this pricing? Most common method, pricing of goods sold to related parties is comparable to the price charged to unrelated third parties. Okay. However, mind you, friends, this comparison which you're doing to prices charges to unrelated party, you will have to make efforts to ensure that this is after adjusting volume, credit terms, delivery cost, and market factor. Correct? Because there can be two cases. The terms and condition us can generally may not be the same. It could be substantially the same as those offered to independent customers. Correct? So ensure you go through the credit period, delivery obligation, what is the warranty, etc. Because you will have some many a time if the related party is granted preferential pricing, then that is based on volume of purchase, long-term commitment, and distribution agreement, correct? If there is. And that justifies the difference with regard to why bulk discounts are given because of the nature of the strategic tie-up you're doing, correct? So hence, many a times when you're talking of comparable, correct? Comparable uncontrolled price, it need not be virtually same. It could be substantially the same and discounted for certain specific matters of volume, commit and commitment, which you will have to document it properly. Many a times you'll have transfer pricing reports, correct? And specifically, if there is a cross border, if a transfer pricing report or benchmarking analysis has been carried out, please take that. That can help you substantiating why it is in the best interest of the company. For example, if there is no clear commercial rationale, correct? No margin manipulation, there is no evidence of profit shifting or cost under recovery, which we call, or manipulation of margin. Proper documentation should be available that the transaction has clear commercial rationale, correct? You will have to get into that. Recurring and operational transactions, you will have to ensure forms as part of your ongoing operations. It is tax compliant completely, correct? Where is it with the secretarial department will probably need further quizzing in this matter, correct? Probably with accounts department and other, if there is significant deviation from pricing to third parties without justification. I gave you multiple justification just few minutes back of what could be the strategic intent, how you can document it, because many of it will be strategic in nature and not financial in nature. But if there are lack of written agreements and justification, you will have to ask them to create that. If the transaction value is inconsistent with the past trend, again you will have to dig deep. Terms more favorable than those offered to unrelated. I gave you multiple examples. What are the documentation you will have to do for this? One of unusual transaction lacking business rationale. Again, strategic intent coming. Goods to related party is at arm's length, compliant with your RPT policy, section 188, relevant accounting standard, and is in the best interest of the company. Last but not the least, you will have to give comfort to your audit committee that management one will undertake periodic review of related party transaction. You will continue maintaining benchmarking. It's not a one time, correct? It has to be a continuous effort. Customer comparison will be continued to be done. and include these transactions for audit committee review periodically. If you have done this, I think you're mostly through it. And as I said, where many a time secretarial department will need to a deep dip pricing if there is significantly below market. One off we said you'll have to go a little bit deep. We will now go to the next loans and advances. In loans and advances, as you are aware, in terms of sources, you have to say sources. You'll have internal, whether in terms of profit, depreciation, sale of assets, external sources for giving loans, long term, that is share capital, loan capital, overdraft, leasing, etc. More importantly, if you see what is required for loans is if you see nature of indebtedness, what are they trying to say? The specific type of debt instrument used. If you, is it a term loan, working capital loan, debenture, bond? What is the total cost of borrowing before you're giving? What is the interest rate at which you are borrowing? What is the processing fees, upfront charges, entire cost? What is the tenure, length, period, due date? Other details, whether the borrowing which you are doing is secured, whether it is unsecured, what were the applicable terms and covenants, purpose and ultimate beneficiary of the funds, credit rating, and this ultimate beneficiary is coming multiple times, as you're aware, many a times. Recently, there were 2 or 3 cases, correct, where a, a, a particular company gives it to a unrelated party, and the unrelated party is transferring probably to a related party. So hence, who's the ultimate beneficiary is needs to come credit rating of the related party if available, or if you don't have credit rating, assessment of credit worthiness, details of any details or defaults on borrowings by the related party in the last 3 years, justification why RPT is in the best interest, correct? All this intention is to compare the company's cost of borrowing from its own lenders to the rate at which it proposes to lend, deposit, or advance friend, correct? The transactions, the whole purpose is to ensure that they are not structured friends in a manner which will unreasonably benefit related parties, correct? At the expense of the listed company. Correct. So while you will have many things which you will require, you will have to go into proper documentation to say that the transaction through entered with a related party, and it many a times in terms of loans, specifically in a company like a manufacturing entity, what I find is your company is engaged in manufacturing. How are you giving granting loans? How is it coming off as part of your main business operation? And first you'll have to document that there is a past practice and almost a business model in the group, negating the uncertainty that the transaction is outside the scope of your regular business activity. For example, you will have to document why are you giving this loan to the related party beyond beyond financial transactions, correct? The transaction sometimes you will say is essential for uninterrupted operation, sound operational or strategic reason for giving the loan. Transaction has a substance and is not primarily designed for arbitrage or credit arbitrage, which we say. Terms are consistent with what would be available to an unrelated party. Non-financial terms like collateral, covenants, usage restrictions are properly documented and enforceable, correct? The second thing comes disclosure when you're talking of rate of interest at which listed entities borrowing. If you don't have borrowing with a comparative maturity profile, then you will have to disclose to the audit committee that I actually first come clean. Listed entity does not have borrowings with a comparable maturity. Then I will give minimum, maximum, and average interest rate. Okay, all on ongoing borrowing. This signals transparency. And the second important, what are the external benchmark like SBI marginal cost of funds, corporate bond yield rates, published interest rates, which is in public, yield curves? Accordingly, at what rate are you giving, correct? Because if you do not have a maturity profile and suppose you've done internal rate interpolation, correct? If you have used such interpolation, that is what you mean by interpolation is estimating, say, a 5-year rate from 3-year and 7-year internal rate explains clearly, correct? For example, if you can go to the audit committee and say, while the company does not have a borrowing of identical maturity, the rate has been determined by interpolating between its existing, say, I've got a 3 year and 7 year borrowing. So I have adjusted that for based on prevailing market conditions, correct? How will I document independent assessment? If you have a transfer pricing report, an independent evaluation report, or an internal treasury assessment, then you can make a mention that the rate has been independently assessed by the treasury team, considering current borrowing cost in the market for similar tenures and credit profiles, correct? And what could be a standard or a sample working note which you can give to the company, the audit committee, say the interest rate of 8.5%. Say if you're wanting to say interest rate of 8.5% for the loan given to the related party has been determined basis external market benchmark, as the company does not have borrowings of equivalent tenure, internal comparables were not available for the 5 year tenure. Market data for example, a double A rated 5 year instrument suggests rates are in the range of 8.2 to 8.7, and hence you say 8.5 finds rate. If possible, include footnote or annexure showing the benchmarking template. Document this in the audit committee ISN table. Disclose this nuance in the explanatory statement if it is going to the shareholder. Correct. The next point is, if you do not have a credit rating of the related party, then have assessment in terms of internal return, independent benchmarking, management has presented proper rational, correct, and a mechanism for regular review. So for interest rate justification was it is, I've given it in the slide. It is comparable to prevalent market rates already given the slide. Don't want to repeat. Security consistent with market price. Tenure in line with typical third party borrowing. Repayment terms clearly defined. Covenants, if any, should not be more lenient than those given to unrelated. What is the credit assessment and what is the purpose of loan? So what should be disclosed when you say if no credit rating is available for a related party, correct? The first inform audit committee, as I said, always complete disclosure and go clean. The related party has not been assigned any credit rating by whatever those registered credit rating. This ensures clarity in the audit committee and it avoids the impression that the rating was overlooked by the management. Then you go to the second documentation of saying what is the justification for processing without a rating. Disclose basis of commercial decision and risk management despite lack of rating, correct? We talked about internal assessment, track record, historical repayment behavior, intra-group understanding, correct? Where no external credit available rating is available. So what will this show? It will show that due diligence is being done in the absence of proper rating, correct? And uh, a standard documentation, if you say, is while no external rating is there, what is it basis? And many a time you also make optional structures, and one of the optional structures which are available in the market which you say is which we call standard structured obligation rating and credit enhancement rating. These are the two things which is there, and let me give you a brief of both, correct? What do you mean by a structured obligation rating? See, this rating is not solely based on the issuer's related party's credit profile, but basis structural elements. For example, you will have escrow accounts, cash flow waterfalls, guarantees from third parties, collaterals, reserve accounts. So these are legal and structural protection, correct? These are often put in place to protect investors, especially in default scenarios. Example, a debt obligation guaranteed by an irrevocable payment structure via an escrow mechanism by the parent, for example. So what it happens, you will automatically have a notch up of the credit rating. For example, the structured obligating rating will generally be higher than the issuer's own rating because it will take into consideration the structural features which significantly mitigate risk, correct? It is, of course, it will be still subject to counterparty risk, legal enforceability, and operational risks. Okay. The second, which we call is credit enhancement. Correct. And what is credit enhancement? Guarantees, say, from a third party like your parent listed entities, bank or government, letter of credits, insurance wraps, which we call it, guarantee from multilateral institution. So internal credit enhancement, while all these which we call is external, where you are giving a guarantee from the parent, etc., even internal credit enhancement takes place. How is it? Revenues routed through a ring fence escrow mechanism, debt service reserve account, correct? Over collateral and cash sweep, which we call, or subordination, that is, junior tranches absorb losses before senior tranches do. And many a times, if you see the credit rating, while you will have a triple B rating for that party, you will have double A, and into bracket sometimes it will be written CE. That means there is a credit enhancement. Suppose that triple B has become an A plus and it is become into bracket SO, in which case you will have to understand there is a structured obligation involved in this, correct? Next point, if a listed entity has borrowed money from multiple banks or lenders at different rates, correct? How should will you? Again, as I said, be clear to the audit committee, give min max average rate. In such a scenario, secretarial needs to get backup from finance of transfer of that there is no transfer of economic benefit through credit arbitrage, correct? What is it which they are trying to say? That when are you probably digging deeper? Your company has a strong credit rating, it lends to a related party, subsidiary, promoter, group company at a similar or slightly higher rate. So, on the face of it, friends, what will it appear? On the face, it will appear as if it is clearly above board, but probably it is not at arm's length. Hence, you will have to document, compare borrowing, rate of interest, correct? Intention is to compare company's cost of borrowing from that of its lenders at which it proposes to lend, correct? Correct. Listed entities cost, and you will have to ask all these documents and dig deeper specifically where the gap or the margin between what you have borrowed and what you are lending is, say, wafer thin, less than zero point 0.1 or something, it can indicate that the benefit of listed entities credit rating is being passed to a related party. Hence, you will have to do enough documentation of the related parties' independent credit worthiness. We talked about credit rating, prior borrowing for track record, sufficient net worth, and even if the RP has to do borrow independently, what would be the interest rate, correct? And based on that, you will have to ensure that you make a documentation that there is no fund trail. Document that the transaction does not involve any back-to-back fund timing, correct? A listed entity borrows and immediately gives it to RPT, correct? Examine terms and conditions, correct? Internal rate comparable with it all. Check transfer pricing and audit committee and the notes of strategic nature also, which will help you a lot when you're doing loans and investment transaction, specifically to address the concerns, correct? So if the indicator is narrow margin between borrowing, you have to document no transfer of benefit is done. If there is lack of credit rating, no implicit dependency, documentation. And I told you how it is. If the indicator is related party could not have independently borrowed on same terms, why there is no favoritism, why are there other reason, no collateral, why it is still at arm's length, no risk premium or opportunity cost building, no economic loss to the shareholders, how it is, correct? So in this term, secretarial department can really do proper documentation and finally place it to the audit committee to say that while the company has borrowed, say at 7.5%, correct, and extended a loan at 8%, the related party, you can give a documentation that it does possess an independent credit rating and basis its own capability or rating, it is able to access funds at comparable terms in the market. This margin of 0.5%, indeed, you will have to say, reflects an adequate risk adjusted return, and is indicative of arm's length. And if no credit rating, we've discussed in terms of internal rate, return, independent reports, etc. Ensure this documentation is done specifically where there is no credit rating, etc. Correct? We will now shift to guarantee quickly. And uh, one of the things in the guarantee which I say, what is the rationale and how are you create, whether it will create a legally binding obligation, correct? In terms of rationale, facilitate, what is it rationale I've given, I'm not going to repeat it. More important, which is there is, what are the contractual provisions as to how you're going to recover it. For 3 points basically comes indemnity, subrogation rights, and security, correct? Evaluate enforceability, assess adequacy of provisions, correct? Ask your business team, are they confident of the steps and what are the steps they are going to take in case this guarantee is invoked, correct? So, indemnity, the first one is a document where the related party, say a subsidiary, has agreed to reimburse to the listed entity as guarantor for any money it pays under the guarantee. Without indemnity, the listed entity has no clear contractual right to claim back the money from the subco or RP. So, what is the typical clause which you'll have? You will generally put a clause saying the borrower shall indemnify and keep indemnified the guarantor against all amounts paid by the guarantor pursuant to the invocation of guarantee together with interest, costs, and expenses. Correct? Let's go to second, subrogation. If the guarantee is invoked and the listed entity has to pay the lender, the listed entity as guarantor automatically will have to step into the shoes of the lender and recover the amount. While many professionals argue out that subrogation is available under Indian Contract Act, but according to me, it is a best practice to make it explicitly in the documentation. And a typical clause which you can give is upon any payment made by the listed entity as a guarantor under the guarantee, the guarantor, that means you as a listed entity, shall be entitled to all rights, remedies, and securities of the lender against the related party as borrower to the extent of such payment. The third point which is mentioned is security. Whether the related party as the borrower has created any security in favor of the listed entity guarantor, correct? Provide a tangible enforceable mechanism. If borrower defaults in reimbursing, do you have enough backup for it? So what is the comfort you are going to give to the audit committee is that guarantee comfort letter is accompanied with any of the three backup documentation which is there. 1 minute. Sorry, any of the three backup documentation which is there, that is indemnity, subrogation, or security, correct? This is really important because you have to give a comfort to the audit committee that see there is a real enforceable mechanism for recovery from the related party, correct? Because why I'm telling you this, if there is no, there is actually you will be asked to make a provision immediately. And of course, I don't want to get into the PPR, probable possible remote which I have already covered in one of those LODR provisions which we did with ICSI. You can go through it. You have to give that there is a real enforceable mechanism and the terms of guarantor, comfort letter, going concern, correct, all that. This is all to ensure that it is enforceable, recovery is possible. Otherwise, you will have to get into either a provisioning or a contingent liability, correct? More importantly, it also comes within its ambit comfort letters and performance guarantee. Be very careful. What is a comfort letter, friends? A non binding written assurance issued by a parent, correct? It is on a best endeavor basis. indicating it intends to support the financial obligation. Here, specifically for companies, what are the broad things you should look for, or make a checklist of what comes? Letters from the holding company confirming support to subsidiaries credit obligation. What are all these letters given? Ask finance team. Promoter affirmation, if the specifically if the listed entity is a promoter to the subsidiaries, promoter affirmations to banks that financial support will be extended when needed. Ask finance what are the assurance given that the parent will not withdraw support during the long term. Ask finance for letters issued for credit rating support or vendor negotiation. Ask legal team to see the language of the comfort letters and that they do not create a legal liability like a guarantee. Then we'll go to performance guarantee. Performance guarantee is legally enforceable commitment. Is it really? You will have to go through the language, correct? What is the commitment given by the parent, correct? Document whether performance guarantee is covered under B4. That is it in the nature of a security, contractual commitment, which have a monetary value? And what will come, friends? Parent company guarantee for timely completion of a project by a subsidiary. Many a times parent give. Bank guarantees are given to a subsidiary, but it is backed by the holding company for contracts undertaken by listed entities. Sorry, group entities, what I mean. Guarantees for quality, deliverables, or milestones in customer contracts. Bid performance bonds issued on behalf of related parties, correct? You will have to go through into all this and then probably make a mention clearly into this, correct? So while we have to go into other verticals of borrowings, royalty, sale of asset, I want to spend some time based on the request which had come from ICSI that I will go into control assessment equally, correct? So as you're aware, many company secretaries will get whole lot of uh, shareholder agreements, and they will have to then assess whether there is control, whether there is significant influence. Basis on that, you will have to see whether the company in turn becomes a subsidiary, associate, or is it a mere financial asset, correct? So even in terms of A2, correct, where there is indirect shareholding means shareholding through a person over which listed entity has control. This again talks of control, not significant influence. That means if you have an entity where you have significant influence, that company's shareholding in the other related party need not. And where it is individual shareholding, even relatives will have to be taken. Correct? What is control? 16(1)(b) LODR, friends, clearly refers to SAST, right to appoint majority directors or to control management or policy decisions. And this can be done, friends, by way, that means right to appoint majority or right to control management or policy decisions can be done directly. It can be done indirectly by virtue of shareholding agreements, management rights, uh, your shareholding, voting agreements, or in any other manner, correct? Uh, so control can be by way of these four methodologies: majority shareholding, right to appoint majority of directors, right to control management, right to control policy decision, correct? These are the four. So you will have to take confirmations from promoters, directors, KMP, etc., regarding controlled entities within the ambit of indirect interest, as details of promoter, director, KMP, person of the related listed entity who have interest in the transaction directly or indirectly will need to be provided. Indirect can only happen through controlled entities, we saw, and hence if you see the two, point number 2 and 3, if you see right to appoint majority, and then the third is controlling management or policy decision. Right to appoint, if you see majority is what we call is a de jure control, correct? Which includes I got a right to appoint majority, whether I exercise it or no, I have, it is a de jure control, it will come as part. The second part, if you say so is more de facto control. That means so long as a person or persons acting in concert, directly or indirectly, can positively influence in any manner management or policy decision, they will be said to be in control, correct? So let us peel the onion a little bit. What do you mean by right to control the management? What is a management decision? Management decision, friends, is a decision to be taken as to how the corporate body is to be run in its day-to-day affairs. A policy decision on the other, the point number four here in the slide, policy decision. What will be the policy decision on the other hand? It would be a decision that would be beyond running day-to-day affairs. That is long-term decisions. So long as management or policy decisions can be or are in fact taken by virtue of shareholding, management rights, shareholder agreements, voting agreements, or otherwise, control will said to be existing. Correct? Here, there is a very nice Supreme Court judgment. It is in the case of ArcelorMittal, if I'm not mistaken, interpreting the meaning of control. There, they have very nicely given a metaphor of a vehicle and say the question the judge had said would be whether the investor controls the steering, accelerator, gears, and brakes. If the answer to these questions is an affirmative, then alone would you be in control of the company, correct? So let us take some few examples coming out of the shareholder agreements, friends, and which you go through on a day-to-day basis or sometimes when it is referred to secretarial, how it will help you. The first one, up if you have got a clause to say the right to approve, for example, the investor will have a right to say so long as it holds a particular percentage, you cannot without their prior written consent alter, modify or amend memorandum of association or article. You cannot alter the share capital of the company. You cannot do any new issuance of shares, variation of rights. You cannot approve any scheme of amalgamation, merger, consolidation, reorganization. Are these rights in such a way that it is directly getting into positive operational control? I- So let me answer it. These rights are protective. They safeguard the investor's position, but these do not give investors current power to direct relevant activities. That is day to day. What we said, management of policy decisions, correct? It is not giving them. The basis, the theory propounded by the Supreme Court, such right do not confer control. The company secretary should classify investment if it is if you have shareholding more than 20% or simple financial information investment if it is less than 20, and depending on the other clauses you will have to document, but certainly this will not come into control category, and you will have to make documentation that these are protective rights and conclude they are not substantive rights impacting control. Next example, corporate actions, correct? Here, the clause in the shareholder agreement says without the prior consent of the investor, the company cannot enter into merger, consolidation, amalgamation, arrangement. You cannot do a slump sale, disposal of transfer, sale, or any other sale of your assets or business undertaking, correct? What are the consent required? Merger, slump sale, sale of assets. Okay. What are the questions the company secretary should ask in these? First question: do these rights amount to veto rights? Do these rights amount to protective rights for safeguarding the investor's capital? Yes or no? Do they give current power to direct relevant activities? That means, are they directing your day to day management or financial policies? Are they substantive and therefore create control? Correct? Secretarial basis the guidance which broadly I gave. These investor rights are protective, and you will have to document that these rights amount to protective. They are veto rights, but yet it is coming under the protective because it is merely required to safeguard the investor's capital. They do not give him power to direct relevant activities. They are not substantive rights and do not create control. SEBI should document and conclude that investors' rights are protective and document this in the working papers. Okay, is that clear? Because these are all things of saying that I have invested in your company, say a 10% investment. I'll not allow you to suddenly merge with any other company or suddenly sell some assets which are important for the business or do some other without. So I am in a manner protecting my capital. Protecting my capital is not equal to be in the driver's seat. Is that clear? Let's take a third example. Information right. What is it over here? The saying, so long as the investor has so and so, the company will have to deliver quarterly financial results within 30-45 days. Provide audited financial results. Here it is even requiring to provide annual operating plan, business budget, management reports, etc. What is it? Will it tantamount to control? Correct. Here again, friends, if you see, this gives the investor what I will call transparency and oversight, but no authority to approve or alter financials or budgets. These are protective, participative rights, not substantive rights over relative activities. They do not create control. And as we saw in the earlier case, at most, friends, they may support significant influence if combined with other factors. Say you got more than 20% shareholding, you got a board seat. But for control, it is not. Secretarial should document that these are information rights as part of the shareholder agreement. However, they are not control. Okay, they are merely transparency and oversight rights. Correct. This will really help. So let's go to the fourth example of observer rights. Here, so long as the investor has a particular percentage, they will be entitled to nominate one individual observer to attend your board meetings. The observer shall be entitled to receive notice, agenda, paper circulated to the members of the board. They will not be considered a member, they will not have voting right, but they will have access to all information and materials provided to the directors. Here again, friend, this right gives access to information and deliberation, but no power to decide or vote. It is a participative protective right, not a substantive right. It does not confer control. It may support significant influence when combined, I told, with shareholding more than 20%, etc. Secretarial should document in board or your audit committee paper that this observer's role is non-voting, and this will come under board participation observer rights for AC, but certainly not control. Let's go to fifth example, sorry. Right of first refusal, tag along, drag along rights. Here, if you see the shareholders, if the in the event any shareholders propose to sell shares to any third party, the selling shareholders will first be required to offer such shares to the other existing shareholders, correct? But they will have to do it on the same terms and condition. The non-selling shareholders will have a right but not an obligation to purchase, correct, within whatever number of days. Then there is a tag along. If the selling shareholders proposes to sell to a third party, non-selling shareholders shall have a right to sell along with the selling shareholder, correct, on the same term. Next is drag along. That means if the shareholder, correct, approves the sale of the shares to a bona fide third party, then this shareholder can drag the other shareholders. That means the remaining shareholders will also be required to sell the shares to such purchaser on the same terms and conditions, thereby ensuring a complete transfer of ownership. Okay, so the question is whether these are actually giving protection, protective rights, or is it control, correct? What are these rights? Right of first refusal, tag along, drag along right. So you will have to document with reason that these deal with exit liquidity, but not control over activities. These rights govern exit and transferability of shares. They do not grant current power to direct relevant activities. They are protective rights only. If combined with more than 20%, they may indicate significant. That is only for your knowledge. But for documentation, clearly document these will come under exit and liquidity rights, not control for the purpose of this. The next is affirmative votes, correct? Requirement of the investor consent for extraordinary decision, change of business line, related party, correct? Here you will have to take approval of the investor to say if I want to change or alter the primary business line. If the company wants to enter a related party transaction, if the company wants to create any encumbrance, say lease, transfer, otherwise, if you have to issue further share, approve any scheme of merger, borrow amounts exceeding a particular, all this requires the investor's approval, correct? These are affirmative votes for reserved matters, correct? Requirement of investors' consent is required, correct? Specifically, change of business line. Here again, I will say these are protect veto rights undoubtedly, but yet protective, not rights to direct relevant activities. These rights restrict management from taking certain strategic decision without investors. They are protective veto rights because they prevent adverse changes for the investors, but do not give the investor power to initiate or direct relevant activities. Although, so hence you will have to understand every veto right is also not, even though if it is negative. So, one thing coming out of another Supreme Court judgment is to say that even negative rights will fall under control, but those negative rights will have to be substantial. So here it is although veto rights, but they do not constitute control. They are not interfering in your business as usual. And of course, as mentioned earlier, if along with other clauses, like if other along with his other 20% shareholding, board representation, this may at best get into significant influence, correct? But certainly not control. So secretarial will have to document reasons with relevant clauses of the shareholder agreement, reasons whatever I mentioned as to why these rights are protective, these rights are not substantive, and document reason rationale, which we call in the audit committee working papers. So hence, when you're doing any investment in an entity with SHA, first see whether the other investors hold 50%. Are they holding between 20 to 50%? Are they minority veto rights? Are they protective or they are crossing the line? Depending on that, it will have to be determined as whether it is a subsidiary, whether it is coming under joint control, associate, or it is merely an investment. Next question is the shareholder holding 33%, and that investment's consent is required to before you approve your results. Would it be control? This again, friend, this is a core governance matter. I undoubtedly agree. This is veto over statutory compliance, correct? It is not, I will have to go through what are the other rights. Okay, this is just a question which had come. So if the other rights are, say, it is coupled with veto rights on budgets, operations, your strategy, then it is control, correct? However, if it is merely uh, approval of audited financial results, then it will not cross that line because control is recognized as veto if it extends to policy, strategy, and operations, correct? So, hence, this will not come under control. The next question, shareholder has a right for I have intentionally removed right to appoint majority of director. Because if it is right to appoint majority of director, it will straight away come as part of the definition, correct? I have deleted that and I said that this investor has now a right to appoint key managerial personnel, CEO, CFO, MD. That person has got right to remove directors, correct? Because he's got the clause says appointment, reappointment, or removal of KMP, managing director, CFO, company secretary. In fact, any material change in the terms of employment go, creation of any new position of KMP, you'll seek approval. So, so here again, you will have to go into this will is it coming into the second category? What is the first which I have deleted? Right to appoint majority of directors, friend. What is the second? Is it controlling the management or policy decision? That means even without a majority shareholding, is the investor dictating management or policy decisions on me? Then it is control. So one way of looking at it is KMP appointments, there are several judgments which clearly tell you it equals control. KMPs, regulators and judgments say are the nerve center of the company. CEO, MD runs day-to-day operation. CFO, for example, controls financial decision. CS compliance. Whoever has got a right to appoint or remove KMPs effectively controls management functioning, correct? Even in SEBI informal guidance and SAT cases, they have said that right to appoint or remove KMP, especially CEO, MD, CFO, they have been considered as management rights. It is equal to consider, correct? And even if the whole investor in this case is only holding 33%, but if he has the right to appoint KMP, it will come under what we said in the first two slides. We said it will come under de facto control, correct? And difference, this is difference. Why is it different? How is it different from normal minority protection? A question will be asked, because you will say just now, NS, you told that if it is for protection, then it doesn't control, correct? This is how it is different. Mean, if there is minority veto rights, like we talked about related party, issuance of new shares, articles change, they are typically considered by courts as protective rights, not control. But when the veto and consent right extend to operational control, and which is appointment, reappointment of a KMPs or day-to-day management, then it crosses that thin line into positive control. Correct? So even so many a times, even if shareholding is small, if a shareholder consent is required for approval of annual business plans, raising capital, approving of borrowings, dividend, entering into major contract, change in nature, correct? Sale of substantial asset, merger, demerger. But if this is combined with your business plan and operation, then it is crossing control. Let us see the earlier slide. I said, ask yourself, is it substantive rights over relevant activities? If it is, then it is joint control. Here, if you say they are substantive right because it is crossing operations, business strategy, and operation business line, hence it will be joint control. Because it is a 50-50, both shareholders, it will come under joint venture and joint control. Second, let's go for a 60-40. You have hold 60%. However, the 40% minority shareholder has got a veto on acquisitions, borrowing, business line, and operating line. Here again, it is crossing your operation. It will be joint control, although the other guy has 40%. Correct? Now let me take it. It is actually all real-time cases. I've just deleted the names of the parties and just given you the flavor. Here is a case of three parties into an agreement. The board is 2-2-2. All three parties have appointed two nominees each. 75% approval for business toll financing. Collective rights, no single party controls. Hence, it is joint control. Why it equals joint controls, friend? Because if you're talking about business operation line, toll financing, neither party can act alone, and hence decision requires joint approval. It will tantamount to joint control. Point number four, 70-30. Okay. Now go 30% can block winding up articles, correct? So you have subsidiary and you have majority, but the 30% are can only block winding up and change in certain article. This, like we said earlier, will be protective rights. Okay. Next, you have less than 20% information rights, correct? Again, we said it is information rights. It will be merely an information here, so there will be no even significant influence. Next case, you have a 25% stake observer. We again say non-substantive rights. Here you say majority plus appointment rights, correct? You have got appointment rights and sole authority to appoint. We said clearly said it will come under control. Okay, next, de facto via SHA, less than 50%, but exclusively rights over budgets, capex, and borrowings. We said they are key financing and operating policy, and on account of this, control indeed exists, correct? There is a casting vote with a 45% stake, correct? It is in a manner crossing because effectively you are majority in decision making, depending on the board size, correct? Because the investor controls board decisions, correct? Then let us see a case of a 49% stake with affirmative consent required for business strategy. Correct? Here, if the minority shareholders approval is required for business strategy, correct? Is it protective? Answer is no. They are veto and covers and crosses that line and breaches into your operational activities. Next, if the SHA grants power to set business line, pricing, clearly control, correct? 35% stake, but right to appoint 4 out of 6 director. Clearly board dominance and documented as control, correct? So, friends, what I wanted to give you these example and giving you the Supreme Court, while we, friends, we took a leaf of the logic from the Supreme Court judgments in ArcelorMittal. It is just to give you a feel of control. However, you cannot copy paste it blindly. We did not completely, if you see in the examples and how we have assessed, we did not confine to the contours of we did not completely confine and said that section 227 of our Companies Act and SAST only to positive proactive control, as probably that will not be fully sustainable, because in this ArcelorMittal case, the court's restrictive interpretation was context specific. It was arising from the phase management or control under 229A of IBC, and the legislative objective was avoiding over disqualification of resolution applicants, correct? But by contrast, if you are using Companies Act and SAST regulations, contain, because LODR has a direct reference to SAST, correct? Then you have got self-contained, deliberate, broad definitions of control, which have been consistently applied by SEBI and Supreme Courts also in certain cases, correct? So Supreme Court in certain cases have clearly mentioned even negative and positive veto rights will be controlled. Positive though definitely, but even negative rights will be controlled if it is on major strategic matters. So while we get a feel from the ArcelorMittal case of how they have used the metaphor of a vehicle and to say whether indeed they have the steering gear, accelerator and brake, it cannot be transplanted directly, and that means we cannot narrow the scope of control under corporate or security laws, because here the settled position, friends, remain that both positive and negative forms of influence is correct. Veto over key strategic policy matters, annual business plans we sought, budgets, raising capital, appointment of CEO, CFO, MD, major capital expenditure, sale or transfer of substantial asset, then you are crossing the line and getting into control, correct? And if I have to broadly give you one tip, correct, over here, is to just keep one thing in your mind, specifically when it is veto rights. If there is a minor veto, it will come into protective, correct? But if it is a strategic veto, it is directive. Anything which is directive is crossing that thin line and getting into control, correct? We are almost, I was asked to close at 5, correct? Because I'll not touch upon borrowings and other matters, but if there are any other questions, Pooja, over to you. I tried my best to cover whatever is it in the limited time.
Thank you
But
so
if there
much,
are any
sir.
questions, we would love to take it. Go ahead, please.
Yes. First of all, something that was popping regularly in my question box was that how good the session is going.
Oh, it's so complete humility of the participants. And how many participants are there, just for our information?
That I'll have to check and I'll let you
Okay,
know in a while.
okay, please check. But if there are any questions, would love to answer. Otherwise, over to you.
So the first question that I'll be picking up is please explain about the applicability on SME listed entities for following the minimum disclosures after 1st April 25. Can a company obtain advanced shareholder approval for the potential exceeding of RPTs above 50 crores?
Yeah, answer is yes. Undoubtedly, yes. You can.
Okay. Uh, what is a non-financial RPT transaction?
So sorry. What I meant is, I didn't make. It is not a question of non-financial. I think probably people have misunderstood. What
Hmm.
I wanted to say is there are many transactions with the company which you will have to do, correct? And when you're doing a transaction, many of them will be strategic in nature. What I wanted to tell. Are you getting my point?
Yes, yes, yes.
Uh, that means I'm not saying that these are uh, non-financial. All I'm trying to tell this will lack mm, uh, financial backing, correct? For
Right.
example, you will do a lot of transaction, which I said in the group, which may not be financially, only on financial parameters, it will just not go through. That's more important. I gave examples, friends, of brand licensing. We gave example of, since we are an automotive company, we gave example of R&D, correct? Where you have a common R&D, correct? And marketing campaigns we gave. We gave example of cross licensing of patents. We gave example of talent pool, which is more important, correct? All these will, you will have to have strategic intent, correct? And the strategic intent is more important because mere financial numbers will not justify this related party transaction. Because they will not justify, you will have to give your strategic rationale. I've got
Right.
uh, I've got
Right.
unique skills, our proprietary technology at the holding company. All these we said are non-financial strategic matters. Unless you give this justification in terms of economies of scale, resource optimization, correct? You will not be able to go through. Mere financial numbers are not enough for you to justify. So all I'm trying to tell is when I made major non-financial, these are financial numbers are enough, not a justification proceeding with an RPT. The non-financial justifications are more important for you to go into that transaction and merely say that actually these are on commercial terms, operational continuity, alignment. In fact, I'll give you a very nice example which I just received yesterday. Yesterday, one of the things which came to me was a promoter wants to give a land to a related party, to the company. It is vice versa,
Hmm.
and he wants to give it at a nominal rate and not at market rates. And the question was, how does the company ensure that it is at arm's length as per their RPT policy? One of the things which they were ready to prove to say that the promoter also has adjacent land parcels, correct? And what is the confirmation you are going to give? That the company using that land over there is also going to indirectly benefit the promoter, to say that the other land parcels are equally going to benefit out of this. And hence it is in arm's length. What the audit committee and the auditors will like to say is that you don't have a quid pro quo. That means, sir, they will tell you to come clean. If you are the promoter is giving you, you are going to give something in return. That is something you'll have to address. So what I meant by non-financial is non-financial justification, and not that it doesn't have financial at all. Okay.
Nice. Uh, a listed entity gets an order from a foreign LLC. One of the director is an additional director in the Indian subsidiary of the foreign LLC. In this case, will the order be considered as RPT?
No, I'll have to really go to leave it to me because I'm not very clear on this. I'll have to apply
Hmm.
my mind. But what
No
I can
problem.
say is, you leave this question in an email to me. I will answer it back to you, and you can send it back. Okay. Next.
Sure. Uh, in case a listed company intends to give loan to its overseas wholly owned subsidiary, does it require prior approval of audit committee or approval of board of directors only? How do they
So if
determine arm's length price?
Okay, so here again you'll have to say what is the exemption which is provided under 23(5). If the 23(5) clear, if the clear exemption is provided for wholly owned subsidiaries, correct? So then you can take that.
ठीक. Another query is approval has to be obtained from debenture holders per material RPT. We are a high value debt listed entity having multiple NCDs in public. How can we take approval? Is e
No, so
voting
high value
necessary?
debt listed entities, as I mentioned, they do
Hmm.
not, they will, if whatever materiality, if it crossed, you'll have to take audit committee approval, but they
Hmm.
need not come under the listed entities. Industry standard forum need not be, uh, uh, they need not go through that, correct? Because as I said, when you are a high value debt listed entity with effect from 1st September, correct, 1st April 2025, one of the things which had come is to say that what was the standard thing with the companies had come with? Companies had come to say that if for a debt listed entity, we have limited compliance staff, correct? We do not. And if you are asking us to continuously cross refer, correct, to 15 to 27, etc., it's quite, we can't be appointing so many people, correct? Hence, they said, can we have our individual state, there was a demand for an individual state within the listed listing regulations, correct? Hence chapter 5a was regulated, introduced to say that if you are a high value debt listed entity, and that means crossing 1000 crore, then you only have to follow chapter 5a 62b to q. You don't have to follow industry standard forum note at all for related parties. Next.
Cool. This is my last question. What are the implications of a director holding place of profit? Somebody who first joined as employee and gradually became director, what would be the impact?
No, so related party, as I said, office of profit clearly comes within the ambit of 188. You will have to, what I'm saying, apply the contours of 188. If it is coming very clearly under 188, it is a related party, and you will have to do all the disclosures and approval required.
And that is it. Any concluding
So
remarks, sir?
all I can just make a mention. I tried my best to give all whatever types of templates, backups, control assessments to help company secretaries broadly go through this related party regime, which is initiated on 1st September. But I feel with what has come from 12th September, I think the impact on the ISF has comparatively, they have diluted it, because whether it is material RPT, they have the 1000 is for big companies more than 1 lakh crore will really become 5000 crore. The number of items which are going to go to the uh, shareholders this coming AGM season is going to be drastically less, because 1000 to 5000 is huge according to me. Second, even with regard to applicability of ISF, the earlier 1 crore is now shifted to 10 crores. I think all sorts of clarification or whatever industry had asked, I think SEBI has broadly given it all. It is now for us as compliance officer to ensure that every related party, in letter and spirit, we follow the ISF properly, give all relevant comforts, which I've given examples to the audit committee and shareholders, so that all your resolution goes through without any major objection. Thank you. I hope the some amount, the last 2 hours, some amount of learnings has gone to people who have participated, and they will be able to at least the whole purpose of these webinars, correct? Because we have every week ICSI is conducting this, is to ensure how professionals benefit out of it. Pooja.
So, with each new legislation, with each new amendment, there is a heightened responsibility for the professionals. And we are really glad to have you amongst us to handhold us, to guide us, and to lead the way. Thank you so much, sir, for today's session.
Thank you. Thank you. God bless. Bye.
Thank you, sir. जी